Good morning, everybody. Hopefully you had a wonderful weekend and getting ready for the holiday week here. Appreciate you being on the phone call. We got some kind of fun, interesting stuff to cover today, so I think you're going to appreciate the fact that you were on. So first thing is, a lot of guys ask me, well, what I was going to go back and listen to any coaching calls. Which ones would you recommend? And I came up with 10 coaching calls that if you're looking to go back and kind of brush up skills, things like that, these were good ones to go back and look at. And so that was on last week's 5-Minute Moneymaker. Now, first thing we're going to cover is I love this guy, the Irrelevant Investor, Michael Batnick. I follow him. I know a lot of you guys do follow him, but I want to make sure you saw this, the 20 craziest investing facts ever. So let's take a look at these things. There's some things that promote stocks and things that should make us cautious with stocks. And if you think about it, guys, isn't that how we should look at stocks? Our stock's generally a good thing. Our stock's generally a good thing. Nobody's answering. No, I'm kidding. Yes, they're generally a good thing. But if we hop on the bandwagon, they're always a good thing. What can happen? Because when they're a good thing, they're a good thing, and when they're a bad thing, they're a what? Bad thing, exactly. They're really bad. So the first fun fact: since 1916, the Dow has made new all-time highs less than 5% of all days. But in that time, it's up for 25,000%. So 95% of the time you're underwater, the less you look, the better you'll off to be. So that's a great lesson for our clients, right? Because should they be looking at the stock market every single day? You know, when we hear on the news what the stock market is doing, does that really have anything to do with how well they're doing and what's doing today? Nothing whatsoever. The Dow has compounded at less than 3 basis points a day since 1970. Since then, it's up more than 3,000%. So compounding is magic. Compounding is magic. The Dow has only been positive 52% of all days. The average daily return is 0.73 when it's up and 0.76 when it's down. So, guys, when we talk about liquidity on the FIA, and we say, listen, any particular day the market could be what? Any particular day the market could be what? Up or down? Up or down? Up 1%, down 1%. Up 0.73%, down 0.76%. Up 0.5%, down 0.5%. So when we talk about liquidity, are we kind of right on target when we talk about if things are going swimmingly, is a FIA any less or more liquid than money management? Or is money management any less or more liquid than an FIA? On any particular, if the market's going up or down. Which one's more liquid, the FIA or the market when the market's going up? Wow. So all the people that answered market, what should they do, Jeff? Did Jeff make it into work yet?
Yeah, I'm here. Just had to unmute.
So all the people that answered the market is more liquid, what should they do, Jeff?
Go back to the FIA presentation and the tutorial and take a look at it. It's I think it's tutorial 5.
Because when the market is going up, which one's more liquid? Not the FIA and not the market. It really what, Jeff?
It's a horse apiece.
It's a horse apiece. Depends on the day. If the market's up, then guess what's going to be more liquid? The FIA. If the market's down 0.76%, what's more liquid? The FIA. I'm sorry. Yeah, the FIA is. Yeah. So for all of you guys that answer your market, you're making me sad on this Monday morning. Go back and learn the FIA presentation. So, because when the market's going up, it's really a horse apiece. If the market's up that day, 1%, 0.5%, 0.73%, whatever it is, then the market's more liquid. If the market's down that particular day, 1%, 0.5%, 0.76%, then the FIA is more liquid. Now, when the market's way down, which one's more liquid? The FIA. And when the market's way down and we need long-term care or have health care bills, which one's more liquid? The FIA. So I'm glad that I asked this question. I'm surprised that we had so many markets. You need to go back and relearn the FIA presentation. And if you have, if after looking at that FIA presentation, you still don't get it, Get on the call. Get on a call with Jeff or myself. We'll help you out. The Dow has spent more than 40% or more below. More time, 40% or more below highs than within 2% of the highs. So almost 21% of the time, the market is 40% below its highs, and only 2% of it, or 18% of the time, it's within 2% of highs. So what's that tell you? Most times the market's going to be what? Charging or resting? Yeah, it's going to be down or resting. Absolutely. The Dow gained 38 points in the 1970s, guys. Look at this. 38 points in the 1970s. That's crazy. That's crazy. So that's part of that. What when we say over the last 54 years, what percentage of time? Over the last 54 years, what percentage of times has stocks beat inflation? Uh-oh. Yep, Tom's got it. No, Sue, it's the opposite. So maybe I asked it wrong, Sue. How often over the last 54 years has stocks beat inflation? So Tom got it right. Sue, it's actually opposite the answer to what you gave me. David's got it right. Come on, guys. Is it too early in the week for you? Only a third of the time. Because during the 1970s, from 1965 to 1982, 17 years, it did not beat inflation. In fact, it lagged by almost 60%. It lagged inflation by 60%. From 1965 to 82, it lagged inflation by almost by 300. From 66%. And from 2000 to 2016, it lagged inflation. So that means that over the last 54 years, 2/3 of the time, stocks have lagged inflation. 1/3 of the time is made up with inflation. Guys, that fact should be how emblazoned in your head. And why? Let's see if I make this. Why do I keep telling you that this is a fact you should know? What does it do for you? Nick's got it. Nobody else knows it. Nobody else knows it. So what does that make you look like in front of your clients? Exactly. Why am I using the Dow instead of the S&P 500? They're effectively the same thing. The rolling 1-year correlation since 1970 is 0.95. So the Dow and the S&P 500 is basically the same. At the low in 2009, U.S. stocks were back to where they were in 1996. So 2009, they got back all the way back to where they're in 1996. How many people do you think were brave enough to stick it out when that happened? Well, what is that? The nice thing is we got history to show us. What did people do in flocks in 2009? In huge amount, yeah, they all left. Huge amounts of people left and got out. And we all know that, right? Because we've all seen that. Is it Delpher? Where they looked at what is the market average? What are mutual funds average? So what mutual funds have at Delbar? Thank you, Delpher. Delbar. So Delbar shows us that the average rate of do investors get anywhere near the average rate of return of mutual funds over time? Nope. Why not? Why don't they get the average rate of return of mutual funds? Because they what? They bail out. Exactly right. They get out at the worst time and they get in at the worst time. At the low in 2009, Japanese stocks were back to where they were in 1980. Holy cow. They were back to where they were in 1980. So guys, what has the Japanese market done for the last 30, 40 years? Holy cow, look at that. That's crazy. And is the Japanese a developed market? So please explain to me how the Japanese market is different than ours. You can't explain that, then you have to be able to. Then you should be worried. Why? Well, they have an older population, but so do we now. What's our birth rate as compared to Japan's? Yeah, it could happen here, exactly. So U.S. 1-month Treasury bills went 68 years with a negative real return. U.S. 1-month Treasury bills went 68 years with a negative return. So what's safe in the short run can be risky in the long run. At the bottom of 2009, long-term U.S. government bonds outperformed the stock market over the previous 40 years. Now we're back to how many of your competition you think know that? At the bottom of in 2009, long-term U.S. government bonds outperformed stocks market over the previous 40 years, 4 decades. Now here's something you should keep in mind. What beats bonds? What beats bonds hand over fist? FIAs. Yeah, FIAs. How well do you think FIAs would have performed over those 40 years? They would have killed it if they'd existed. Of course, they didn't exist. Gold and the Dow were both 800 in 1980. Today, gold is $1,300 an ounce, and the Dow is 26,000. So all those gold bugs out there. Hey, I have a little bit of gold, but is gold a great investment for the vast majority of your assets? Not even. Not even. Over the last 20 years, gold is up 340%. Stocks are up 208% with dividends. Now, can there be time when gold is a better investment? We just said here, gold's not a good investment. Now we're saying gold is a good investment. That's the whole thing about investing. What's this proving to us about investing? Gold's not a good investment. Gold is a good investment. Yeah, Till says, good luck investing. No, I would agree with that. Yeah, I'd say it depends. That's everything. It depends. It depends. It depends on the time. The problem is, as we say in our FIA presentation, if I told you I could see into the future, how rich would I be? Dudes, if you could see into the future, how all these things that have happened in the past, how rich would you be? So in the end, do we really have a clue what's going to happen? If we don't have a clue what's going to happen, we have to what? Hedge our bets. Since 1980, gold is up 153%. Inflation's up 230%. So is gold a good inflation hedge? Nope. Commodities trade gained 14% in 2008 when stocks lost 37%. So can sometimes commodities be a good investment? Yeah. Again, we're back to it depends. 2009, they're up 2.5%. Stocks are up. Stocks are up 282% since 2009. So yeah, for that particular year, great investment. So again, if I could see the future and know when to get into commodities and when to get out of commodities, get back into stocks, how rich would we all be? Unbelievably. If you'd invested from 1960 to 1980 and beaten the market by 5% each year, you would have made less money if you'd beaten the market by 5% each year for those 20 years, for those 2 decades. Now, first of all, has there ever been a money manager who's beaten the market 5% a year? No, not even close. But if you had a magical one that could do that from 1960 to 1980, and you would have made less money than if you invested from 1980 to 2000 and underperformed the market by 5% a year. Guys, how powerful is that little phrase right there? How powerful is that factoid? What's that tell us about whether we can beat the market or not beat the market? What's that tell us about our ability to beat the market or not beat the market? That it makes a difference or doesn't make a difference? Or is it all about being in the right place at the right time? Does not make a difference if you can beat the market. Because if you beat the market by 5% from 1960 to 1980, that didn't really, wasn't nearly as good as losing or underperforming the market by 5% from 1980 to 2000. What it says is timing is everything. Always being at the right place at the right time. Problem is, what's the problem with being at the right place at the right time? Yeah, we never know. We don't have a crystal ball. So you got to hedge our bets. Got to hedge your bets. Look at these lucky and unlucky decades. Average 7.5, average 1.8. Make 16.6, 1.9, 3.3, 16.3, 5.2, 1. So guys, these are 10-year chunks of time. How big a difference. When we tell our clients they're going to average 6% rates of return or 8% return or 10% return or whatever we tell them, we're full of what? Crap. That's right, Mark. We're full of crap. Because we can tell them they're going to average that over 100 years. Can we tell them they're going to average that over the next decade when they need to pull money out? So a lot of guys ask me, Mike, you're so anti-financial plans. Why am I anti-financial plans and income plans? Because when you do an income plan or an analysis, or you do a financial plan, you have to do what? You have to guess what they're going to make. And do we have any clue? So why is our sales so powerful? Are we trying to guess what's going to happen in the next 10 years? Yeah, we don't guess. The Dow lost 17% 2029, 34% 1930, 53% 1931, 23% 1932. Holy cow. Yeah, be grateful. Warren Buffett is the greatest investor of all time. In the 20 months leading up to the dot-com peak, Berkshire Hathaway lost 45% of its value. When everybody else was making money hand over fist, he lost almost half of his value. Why did he lose almost half his value? Why? What was he invested in? What is he always invested in? Yeah, he's in value. He loves value companies, Tom. Exactly right. He loves value companies. And value was, at the same time the dot-com was going through the roof, value companies were taking in the shorts. So the NASDAQ, at the same time he lost half its value, the NASDAQ gained 225% over the same time. Again, right place, greatest investor ever. He's in the right place, or he was at the wrong place at the wrong time, wasn't he? So does it matter if you're the greatest investment manager ever if you're at the wrong place at the wrong time? You're right, Mark. From 2002 to 2007, his value kicked butt, though. Yeah, it all came back. So only 47.7% of stocks generated a lifetime return that matched 1 month Treasury bills. Do you get that? Almost half stocks don't generate a lifetime return that match 1 month Treasury bills. That's a frightening fact. Why? Means you better be what? So why does the index perform so well? Why does the index perform so well? Because it doesn't try to guess which half is going to make a ton of money. Because look down here, these stocks here made over 2,000%, and we got all these that very few made more than that. And then we get down to here, that's the median. That's the median. Look at how many stocks underperform. That's crazy. Dow earnings were cut in half in 1908. The index gained 46%. So what's that tell us about the stock market and the economy? Can the stock market go down in a great economy? Yeah. Can the stock market go up in a terrible economy? Yeah, that's right, Till. They're not correlated at all. And essentially, when stocks go down, does it generally have to do with the earnings of the companies? What causes stocks to crash? Well, we're going to get to that. I'm going to leave that question out there. 1949, the stock market is trading at 6.8% earnings. It had a 7.5 dividend yield. 50 years later, it reached 30 times earnings on average and carries just a 1% dividend yield. I love it. These are his comments. These are Batnick's comments. You can calculate everything, yet still not know how investors are going to feel. So what used to be true is what? What used to be true is no longer true. Do you guys remember? I mean, I remember selling annuities in the 90s, and I told people the 3% guarantee. You'll never need that 3% guarantee. I know it's because what did myself and all of the people I was talking to think about a 3% guarantee in the 90s? When was the last time we saw a 3% guarantee? I'm sorry. When was the last time we saw a 3% yield? In the 60s. In the 60s. So that means 30 years we hadn't seen a yield go below 3%. So guess what? Just because it hasn't happened in 30 years, does that mean it's not going to happen tomorrow? No. So we can't. Is there any truisms in the market? I guess there is one. What's the only truism in the market? In investing. Change. That's right. Change. Change. I have no clue. What the rules today are going to change tomorrow. That's the only thing we know. Okay, so that's his 20 fun factoids. 9 bear markets and the events that caused them. So this is out of the investment news. May 1946 to 47. The Dow declines 23%. Sharp winding down of the war effort. Stocks had soared during 42. Since the victory of World War II seemed more likely as the troops came home. However, governmental factory jobs ground to a halt. Industrial production plunged. Investors feared return of the Great Depression. December 1961 to 62. Dow declines 27%. The rise of Cold War fears, labor unrest. The failure of Bay of Pigs invasion of Cuba. Pressure from John F. Kennedy unions to negotiate modest salary increases. The president was furious with the industry, prompted hikes of $6 a ton. My father always told me the businessmen were sons of bitches, and I didn't believe it till now, sparking fear of an anti-business administration. And so February 1966 to October 66, 25% decline, cost of war. The go-go years hit a speed bump. The Federal Reserve warned in March 1965 that the economy was close to overheating. The Treasury bill rates and consumer price index began rising. The U.S. bombing of Hanoi marked a substantial increase in the Vietnam War effort. Now, some people would say that when war goes up, what happened in World War II? When the war started, what happened? When World War II, when the war started, what happened? Yeah, it went up. But here, the war starts heating up, and what's the market do? So even, here another truism. It's what used to work no longer works. December 68 to 70, 35% decline, almost 40. Political turmoil, race riots in Detroit. Martin Luther Jr. King is assassinated. Massive anti-war demonstrations. Inflation rose to 6%. Treasury bills yield 7%. January 73 to 74, 45% decline. Oil embargo, Watergate. April 1980 to August 82, declines 24%. Inflation whip. Paul Volcker becomes the chairman of the Federal Reserve. Set out to crush soaring inflation by raising rates to unprecedented heights. By December 1979, prime hit 21%. Guys, prime hit 21%. Holy cow. 87 to Black Friday in October 87. One of the greatest bull markets of all time was born in the wake of 82 bear market. Buoyed by falling interest rates and a Reagan-era tax cuts, inflation jitters sent the bellwether 10-year Treasury note yield to 10.1% in October 1987 and to from 7% in January, sparking a flight to safety. Dow plunges 22%. March 2002, bull market actually died of fright. Stock prices gleefully soared astonishing heights. Some of the highest flyers didn't actually have earnings. We're going to talk about that here in a second. Selling began in 2000, tearing the technology-laden NASDAQ the hardest. 2000, 2009, we all know what happened there, right? In a brief time, 2006, all you really needed to buy $1 million starter castle was a bright smile and a cowboy mortgage broker. So, but here's the thing. These are vague things. Some of these things have been going on forever. I mean, let's look at the 2000. How long had the market been screaming? How long was the old market overvalued in the dot-com, before the dot-com bubble? 2 weeks or 2 years? 2 weeks or 2 years? Yeah, 2 years. So I want you to understand, not vaguely, because you know what? If everybody knew this was causing the market to crash, why didn't everybody get out before the market crashed? Everybody knew that this was going to cause the market crash. They should have gotten out. Everybody knew that this was going to cause the market crash. They should have gotten out. Everybody knew this was going to cause the market crash. They should get out. The problem is, everybody thinks everything's fine until what? Everybody thinks, oh, this is normal. This is the new 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 normal until what happens? Until it isn't. So these are vague things that cause the market. What actually caused the market to crash? Well, 1929, on September 20th, the London Exchange crashed when Clarence Hathaway was jailed for fraud. Who in their right mind would have said, oh, I know what's going to cause the market to crash? Clarence Hathaway is going to get jailed, and that's what's going to cause the market to crash. Who in their right mind would know that? Except a guy with a crystal ball. That was the trigger. See, things had been bad, or things were problematic. Things are problematic with the market far, far, far sooner than that. But what was the actual thing that on that day, that minute, caused the market to go. Guys, why is that so important to understand that? It's not vague things that cause the market to crash. Vague things set it up. It's kind of like before 1929 or earlier in 29 and in 28, the room was now full of what? Dried newspapers. This wood shed in the back is full of dried newspapers, dry tinder, and it has gasoline. But nobody lit. Did anybody know that the actual match that would light that thing on fire was Clarence Hattrey being jailed? So what should we realize from that? What could happen tomorrow? We don't know. The spark. Because are we living right now in a woodshed? Is the market a woodshed with tons of dry paper there with gasoline in that shed right now? Yes. But you know what? As long as there's never a spark, that's no problem. But the problem is, guess what we're doing every day to that shed? What are we doing that every day to that shed? By artificially having our national leader bully the Fed to keep interest rates down. Is that real growth or is that artificial growth we're creating? By trying to keep the QE. And that when that artificial growth gets overheats, what happens? When that artificial pops, it what? It goes. 1973, 74. Remember the vague thing that Investment News said? It's the Arab oil embargo started in 1973, sparking long gas lines, spiked in prime of 11.5%. The Watergate scandal helped push it. No, that was all that was the tinder in the woodshed. All that was the tinder in the woodshed. What actually caused it? The collapse of the Bretton Woods system. When the Bretton Woods systems collapsed, that's what triggered it. That was the match. 1987, the Iran fired missiles at 2 U.S. flagships. 2000, AOL, who had never, ever, ever had profits, had no profits whatsoever, was able to buy Time Warner, which had been around for decades. Time Warner had been around for how long? Like 100 years. And they had huge profits. Why would a company with no profits be able to buy that company with huge profits? Now, was AOL the first company with no profits to buy a profitable company? No, it wasn't. That's right, Sue, it wasn't. So why was that particular company buying Time Warner? Why was that the trigger? Well, did everybody know AOL was going to buy Time Warner? Did everybody know it? I mean, was that hidden or was that in the Wall Street Journal and every place else, knowing that sale was being negotiated? Yes. So why didn't everybody, if everybody knew that was what's going to cause the market to go down, why didn't everybody get out before, as soon as they knew AOL was negotiating with Time Warner? Because what? They said, oh, that's not a big problem until it became what? A big problem. 2008, what was the trigger? It was the bankruptcy of Lehman. Because those of you that watched what's the name of that great movie about 2008? Somebody help me. That awesome movie with the big something, right? The Big Short. Thank you. The Big Short. If you watch The Big Short, which is an awesome movie, it's very entertaining, but it's also very informative. How long had this problem been going on? Just for a month or so? No, it's been going on for a couple of years. So why was it the bankruptcy of Lehman that finally made people decide, oh, this is problematic? We don't know. It's a trigger. It's emotion. These are all things that the common psyche said, oh, this is a problem. The common psyche said, oh, this is the problem. The common psyche said, this is the problem. The common psyche said, this is the problem. Everybody started bailing at the same time. It wasn't until everybody made the decision at the same time. 2018 in February 2nd, small funds shorting volatility blew up. Two small funds shorting blew up the market in 2018. It recovered quickly, but two small funds shorting volatility blew up. I mean, that's guys. These are we're talking kind of small funds or itsy bitsy teeny weeny funds, and it put the market on its ear. So the thing that we have to understand is we should be in the market, but we should also be what? out of the market. Because there are long periods of time that what? Our clients are not going to make any money. And if they have to pull money out during these times, what's going to happen to their portfolio? See, if we keep, this is just one example of what's happening now with artificially keeping the market high and frothy. That, keeping the Fed interest rates low, guess what? That's good. Isn't keeping the Fed rates low good? Heck yeah. It's what's making the market go up. Is it also bad? Heck yeah, because it's what's making the market go up. So it's good until it what? Until it isn't. And this is the Fed artificially keeping rates low. Is that the only problem that we have in the market right now? Now, I mean, for the last 2 years, have I given you one indicator after another indicator after another indicator flashing red? They're all flashing red. Everybody, the fire marshal has said, you know what? That's a dangerous shed with all that dried newspaper. The neighbor is saying, that's a dangerous shed. Your dad is saying, that's a dangerous shed. Your wife is saying, that's a dangerous shed. Doesn't matter. Until what? Until we see the spark. And at that point, guess what? It's too late. Can you fix it after the spark occurs? Because there's another thing I want you to take a look at here. Oops. So, we say, oh, wait. We need to be in the market, right? Everything's good now, right? Oh, wait, right before what? Falls again. And then it falls, boom, boom, boom. They say, oh, finally, we're starting to recover until what? Do we ever know where we are in this spike? Oh, finally, we're starting to recover. We had a look at technically it's going up. The trend line's going up. Finally, we recovered before what? It goes down. So that the reason, I have money in the market. Oops, doggone it. I have money in the market. Sorry, guys. I'm almost done here. Be patient. I have money in the market. I do have half my money in the market. I have my other half in FIAs. Why? Because I have no friggin' clue what's going to happen tomorrow. And even though I'm not presently pulling money out of my accounts, why do I still have a 50-50? What does it do? What does that 50-50 give me? Gives me intestinal fortitude, because when the market falls 50%, what happened to my pain if the market falls 50%? Keeps me invested, right, Mark, Tom? It keeps me invested in the 50% that's in the market. If it falls 50%, it gives me the intestinal fortitude to not touch that money and let it come back. But if I'm retired and I'm relying on this money to provide income, am I going to have that kind of intestinal fortitude? No. And the clients we're working with, guess what? They're not going to have that intestinal fortitude either, unless you give them that 50% that's guaranteed and say, listen, we got money to pull from here. We got money that didn't go down. We've got this. The plan is working. This is where we can pull money from. Let's not touch that stuff in the market. It's going to come back. We don't know when. Could be 1 year, 3 years, 5 years, 10 years. We don't know, but it will come back. But if we take it out now, it's guaranteed to what? If we take money out now, it's guaranteed what? That's right. It's guaranteed loss. It's guaranteed never to come back. Make sense? So we're in the summer here. Now, I understand we're in a holiday week, but during the summer here, when you get crib notes and motive mastered, your daily practice of your 15-minute drill and the GOTS, 5-minute money makers, that's when you're going to get every client that you want. So you guys, thanks for being on today. I appreciate it. Have a fabulous 4th of July week, and we'll talk to you all next Monday. Thanks, everybody.